and welcome to Instant Insights. At Global Data Strategic Intelligence, we track over 100 tech, industry, ESG, and macro themes impacting all major sectors. I'm Nimrah Sharif, and today I'm joined by Pinky Hiranandani, Associate Project Manager, and Christopher Papadopoulos, Principal Analyst, both in the Strategic Intelligence team here at GD. We will talk about a recent report they worked on, carbon offsets. Hi, Pinky, how are you today?
Hi, Nimrah. I'm good, thank you.
Great. So to begin with, what are carbon offsets and why are they important?
So, carbon offsets are basically tradable certificates which represent 1 ton of carbon dioxide either avoided or removed from the atmosphere. And companies are buying these offsets to basically compensate for their own emissions, which help them claim they are carbon neutral or are on track of achieving net zero. So these offsets can be generated from various kinds of projects, from forest protection, building wind and solar farms, or using carbon removal technologies to remove carbon from the air.
Ah, okay, interesting. And who are the main buyers of these carbon offsets?
So the main buyers of carbon offsets are mainly the energy and tech companies, and these are often, the large carbon emitters, and they are under a lot of pressure to meet climate targets. In fact, in 2024, Shell was the single largest user of carbon credits in the voluntary market, followed by Microsoft. What's interesting is we looked through company filings for 100 largest publicly traded companies by market cap, and we found that nearly half of them are actively buying offsets. So these companies include Boeing, Shell, Novartis, Tencent, and Google. But they're all buying offsets for different reasons. So we've seen that, about 15 companies, including Goldman Sachs, Apple, and ASML, are using offsets to claim they are currently carbon neutral for emissions created by their business operations. So what we call the scope 1 and scope 2 emissions. And we've seen that much smaller group, which wherein companies like Netflix, Palantir, Salesforce, and ServiceNow, they go further and use offsets to cover their full value chain emissions, which we call the scope 1, 2, and 3 emissions. That's a tougher standard because it involves, the entire value chain, including their suppliers, logistics, and customers. Then what we saw is there is a middle group of roughly around 25 companies that buy offsets as a part of a pathway to support a future net zero or carbon neutral target. So these companies plan to scale up purchases over time as they move towards their long-term commitments rather than claiming immediate neutrality. So yes, the market is diverse, and big energy and tech companies are leading the demand, and all of them are buying offsets uh, for various reasons, and their scopes vary from immediate operational neutrality to long-term targets to support their value chain coverage.
Okay, and so you mentioned above some of the, criticisms of some of these companies doing this. And so could you delve in a little bit deeper and how do you think these can be addressed?
Sure. So the carbon offsets market has earned a lot of bad press, especially in the year 2023. There have been high profile investigations and questions around projects on rainforest protection, cook stuff programs, and which actually saw two notable CEOs resign at major market players, that is South Pole and Vera. So the Kariba conversion project, for example, it faced governance and accounting issues that led sellers to admit that their impacts were overstated by large factors. So these scandals have actually dragged the corporate buyers such as Disney, Shell, and Gucci into the headlines since these brands had bought these credits. So the main criticisms that carbon offsets receive is, first of all, greenwashing, and offsets can, be a form of greenwashing when companies use them to avoid making real emission reductions. And there's also criticism around lack of additionality and poor quality. So some projects never deliver the extra emission reductions that they have promised, meaning that the credits were issued for things that would have happened anyway. And also overstating impact and permanence has been a major issue for carbon offsets market. So how these things can be addressed is, buyers have become very pickier. They are doing their due diligence before investing into projects, and corporates and governments are increasingly screening projects for additionality, permanence, and leakage controls rather than just relying on the price alone. Also, we are seeing that, the verifiers and registries are tightening their rules. The methodologies used for counting credits have been made more robust. And so fewer projects are being issued related to earlier years. Another interesting thing that we are seeing in the market is, carbon rating agencies are emerging, and these firms are actually using letter grade ratings, which are commonly used by the credit rating agencies, which basically adds a new level of scrutiny into carbon offset projects. And also, we are seeing better monitoring and verification tools, using tools like satellite imagery, remote sensing, and also academic partnerships is making it easier to check if the projects are actually delivering what they have promised and they're persisting over time.
Well, that's very interesting and seems there's a lot of movement there, which is good to see. And Chris, how has the market demand been so far, and what can we expect in the future?
I suppose the story so far, and Pinky, feel free to add to this if I miss anything. You kind of had this growth phase. You had the 2015 Paris Climate Agreement, and then you had a pretty strong growth phase after that, up until around 2021, 2022. Then 2023 was just this horrible year for the offsets market, where lots of companies ended up on the front page of The Guardian, and in other news outlets, where it was revealed, a lot of the projects they'd invested in basically didn't do what they said, but basically didn't have um, a very strong positive emissions reduction impact. So that year saw some pretty high profile resignations within the offsets market. And I won't go too much into details from those, but since then the market's kind of flatlined. So some people left the market, but others have joined. So it hasn't been a total disaster. It's still a fairly small market, depending on who you ask. It's about a billion, $2 billion turnover a year. But the future is potentially much larger. What's happening now is there's a bit of a shift to quality. So people are buying it. They're still buying, but they don't want to end up on the front of the newspapers involved in a scandal. So they're trying to implement more robust quality controls, and they're being much more selective over the kinds of things they'll buy. Now, the really long-term potential is very large, because if you're a country or if you're a company and you've said, I'm going to achieve net zero or carbon neutrality by 2050, that implies you're going to have to buy lots and lots of these things. So the potential market size is really large. But for the next few years, it's probably not going to, you probably won't see much growth. The political situation in America is sort of anti-ESG at the moment. So you'll see fewer companies there coming in to buy offsets. What you will start to see after that, but this is more for sort of after 2030, you'll see countries starting to buy. So at the minute, countries don't really buy offsets. But there's a framework as part of the Paris Agreement where countries can buy offsets. And a lot of that will start happening after 2030. And then you've got some of the more sort of quality control things that Pinky was talking about, like carbon ratings agencies. And a lot of that will probably start to gain traction again, but probably not just yet. It'll take time for confidence to return. A lot of confidence has just been knocked out of the market, so it's going to take time for that to return, and for some of these longer term growth drivers to come into play. But we think it's happy. I mean, I'm sort of pessimistic up to 2030, and then optimistic beyond that. How about you, Pinky? Would you agree with that?
Yes, Chris, I completely agree with that because given, the current state of market and, the progress that we're expecting in the next few years around quality, around verification, I think things will standardize and improve beyond 2030. So I completely agree to what you say.
Yeah, no, that's great. And Chris, you just mentioned the US political situation there. So, we've got some of the major companies operating from within the US. And so how do you think those companies are going to manage their offsetting risk?
Well, some of them have just kept on buying, but they've shifted to higher quality. So if you look at the big tech companies, they've stopped buying traditional what we'd call avoidance offsets, and they've started buying removal offsets and things like direct air capture or where you plant a new forest, things like that. Some companies just that's one way to manage risk, right? Is just to change the type of offsets you're buying. Another way is just to not buy them at all. Um, so you might have been a buyer and now you're going to stop buying them, or maybe you were thinking about entering the market. Now you're going to delay that for a few years or indefinitely. Um, and then the third option is to sort of buy the more traditional offset types, like forest protection, but then to implement better quality control systems like the rating agencies that Pinky mentioned. And if you look at it on a macro, if you look at the problem on a macro level, at a sort of global level, people in the offsets markets will say, look, we need these avoidance offsets. If we just go for the removal, very high quality offsets, we're not going to get the volume we need to hit these kind of global emissions targets. So on a company level, it is safer to just go for the very, very high quality offsets from a risk perspective. But at a more macro global level, there is there's a lot of people who believe, we need to get that bit of the market to work as well. So people will take that middle option too, I think.
Interesting. And Pinky, did you have any further thoughts on this before we wrap up?
Yeah, so I think, as Chris mentioned, that, it's better to delay buying these offsets until we have these high quality offsets available in the market.
Well, no, thank you both for joining us today and for those instant insights. And I hope you guys enjoyed. Thank you for listening. And from us in Strategic Intelligence, see you next time.